All right, welcome back to another episode of the Black Bullion Show. Bonds tend to be very, very stealthy. Just ask 007. But in all seriousness, guys, investors neglect checking the bond market to their own peril sometimes. Within the market lies leading indicators that predict economic recessions, recoveries, and overall sentiment. Now, in this video, we will try to tie gold's performance, its recent great performance, with investor sentiment with a leading metric from the bond market. But first, if you're new to this channel, please hit that big red subscribe button right down below. Also, please hit the like button, helps to get this economic evangelism right on out there to the masses to bring more people into precious metals. Okay, so the 10 minus 2-year spread. This is what we're looking at here on the Fed's research website. And this is a chart of the current 10-year treasury yield minus the 2-year yield. And without getting too into the weeds here, we want to be able to discern how investors are feeling about the outlook of the economy. Now remember, that does change behavior to drive more risk on or risk off sentiment. You know what I'm leading to or alluding to here, more inflows of gold or not. So this will help us in identifying that, or in this sense, confirming that. So when the curve steepens, the expectation is that a recovery is coming, and there is also the anticipation of inflation. An example of this is the election of Donald Trump back in 2016. Remember when stocks shot up around that time? Well, around the election, around that time, the yield curve actually steepened right around that point. So take a look here. Right around November, things were kind of going up, and then it just steepened, just shot up right there on the 10th. So in more modern times, the yield curve has steepened. Take a look here. Right around March, it steepened in the middle of the month when we got a lot of heavy monetary and fiscal stimulus buzz around in the US. The curve steepened again in early June when everyone felt optimistic about the economy reopening. Things looked like they were going to change for the better. And since then, things have been trending down. Now, the spread continues to be positive, but the market is showing that longer term rates are now heading higher as opposed to short ones. And the shorter ones are down pretty low, as you can see here. And they're pretty low, below 0.2% for, it looks like, 3 years, up until the three-year yield. But back to the longer term rates, they may not increase right away, but when they do, we will see a stronger uptrend in inflation. Now, in the month of July, here we're on the Treasury's website, where we actually have the current month of the yields for all of the major dates. You have 30, 20, 10, all the way down to 1 month. And it shows you the trend over the course of the month. So essentially what we have here for the 10-year is a continued downtrend as investors become increasingly nervous about the economy. They're piling in, driving that yield further and further down. It started at 0.69. It's now down to 0.59, give or take. So as investors succumb to this risk-off mood in the economy, we see that gold continues to get a bid. And as the 10-year continues its descent quicker into quicker in rate than the 2-year moves, that spread will begin to narrow even more. Remember, we are still seeing negative real rates, and that's a positive for the gold price. And so essentially, as the bond market has shown behavior consistent with gold getting a bid, what does that mean for the future of the economy? Well, to me, it basically means that we are expecting, or we should expect, further contraction as people are getting into more risk-off investments and risk-off holdings, and especially as the dollar continues to drop in favor. So where are people going to go? They're going to go to old yellow, and that is gold. All right, guys, thanks again for watching. Please hit that like button. Please subscribe if you're new. Thanks again. It's Black Bullion.